Hello everybody and welcome. Tom Daly here from the Academy of Financial Trading. And we are about to begin your very first lesson in what we are fully sure will be a thoroughly enjoyable series which we call the Foundation Trading Program. We're going to be going through many of the core principles regarding financial trading. We're going to be showing you how the financial markets work and what other participants do in those markets, and then how we can find opportunities as a result of that. So, to begin with, in this lesson, like in all other lessons, we will start out by having a look at our risk warning. It's crucial that we're all aware of the risks associated with trading, with leverage trading, and with investing as well. In all areas, it is the acceptance of those risks which can generate profits and returns for individuals. The way we like to begin, ladies and gentlemen, with this webinar is to really set out the context. Over the next few moments, we're going to be going through many of the questions which I can see quite a lot of you typing in right now. So before we get into that, I guess I just want to show you exactly where we have come from. The Academy of Financial Trading. Who are we and what are we all about? Well, the Academy of Financial Trading was founded in 2012. And over the course of the few months after that, I guess, we actually changed the name. We became an all-encompassing online academy known as the Show Educational Group, or even the Show Academy to start with. So, at this current moment in time, we are actually the largest live educators on the planet. We're educating over 65,000 people every single month, and all in this online and live format. We have offices across 3 continents at this stage, and we're employing over 200 full-time staff. We carry, I'm sure you're aware, a very diverse range of subjects across 10 different languages. So we're quite big, I guess, in the educational space, and we're massively proud of that. So you'll probably have a lot of communication from us over the coming days and over the coming weeks, whether it's from the Academy of Financial Trading or whether it's from, I guess, our parent company, Show Academy. It will all be from that one entity. So that's who we are. That's what we're about. We'd like to think that we're quite good at what we do, but what we do cherish, I guess, more than anything else is the feedback which you give us throughout these webinars. So let's get stuck into this evening and find out exactly why we are all here. Okay, what we want to do is we want to make sure that everybody is fully comfortable as we progress through this webinar series. So the likes of some of the questions coming in already, like about microphones, like about questions themselves, about accessing recordings, all of these types of areas we will be covering in the next few moments. But before we do that, we must start out with the truth about financial trading. And guys, when it comes to financial trading, achieving success and achieving results, it can indeed occur, and in terms of those results, they can be very, very positive. But in order to have those levels of success, we must work hard at what we do. And from our perspective at the Academy of Financial Trading, we take, I guess, a bit of a different trajectory in terms of our teaching. We do view ourselves as a fully, I suppose, academic-based teaching institution, and that what we are focused upon is to help you to achieve consistent and conservative growth. And what we mean by that is from time to time people will come to us and they might be looking to make 400 or 500% of a return per month. We're not going to tell you that is possible because that would be absolutely crazy for us to say. So we're not going to make false promises. We are going to build a fully foundation level of knowledge. We're going to encourage you to attend these live events and to ask as many questions as you can, and to make this a truly educational experience. Because you probably know, and we certainly know, that trading can be extremely rewarding. So how we intend on teaching is very, very important. We'll start out with a particular subject matter and we'll define it and we'll say what it is from an overview perspective. Then we're going to teach you through interaction, through asking you questions, through stimulating your brain to learn and to grasp this subject matter. All of this, breaking it down into bite-sized chapters, will lead you to appreciate how the financial markets conceptually work, okay? And how we can find opportunities in those markets. That's exactly what we are looking at from this foundation trading program. Over and above that, we'll be helping you to achieve your trading edge. And with your trading edge, I guess it's the advantage which you have got in the marketplace, which is crucially important for you. Okay? It gives you a justification. From there, we will now have a look and find out why we are all here. And why we're all here is to look at charts, at markets, at instruments like this. This is an instrument. This is a chart. This is a market. And it's a market specifically on crude oil. It's a monthly chart where we can see what has happened to the price of oil, where it was right up at that $140 per barrel price back on the 1st of June 2008, up to the point in time where we are currently at, down at that $32, $33 level. And we're going to be looking for areas of interest, just like you can see on the screen in front of you now. And these areas of interest, we will learn, do not occur in any haphazard fashion. They occur in a very precise way, that there always is a reason as to why a price will increase to a certain level and then decrease, or why a price will decrease to a certain level and then increase. And it is the methodologies behind these increases and decreases which we will be looking at over the coming weeks and trying to find our trading edge. Okay, so the agenda, exactly the layout of the classes. What is the running order of our teaching? Your first week, guys, that will lay out the foundation of your foundation trading program. For those who have experience, some of the first week it might be a little bit repetitious, but I guess we must play it safe in terms of ensuring that we're all on the same page. So this evening we're going to get stuck into what moves the price in markets. Then in 2 days' time, we're going to look at the mechanics of trading. How does one physically place a trade? Your second week is when things start getting really exciting. And from there, what we're looking at is types and ways of analyzing the markets. Your third week kicks off even more important areas, all about finding opportunities. Your 8th lesson is going to be extremely important for a whole variety of reasons, but most importantly because it talks about you becoming a counter-retail trader. And what that is trading like those more successful institutes which exist. Your 4th week, we call that the risk management week. Why do we call it that? It's because hopefully it will scare away all of those people who wanted to make 500% profit. What this focuses upon is to protect that which you have worked hard for, and protecting profits in the marketplace as well. So what are the objectives? Well, our objectives essentially are to show you that every single professional must start somewhere. People, they often come to learn from us, and they might have seen advertisements from people who might consider themselves to be competitors of ours, especially in the educational space. And what happens is people expect that by the end of this webinar they'll be able to give in their notice and put in an order for their Lamborghini. That's not our style. That's not how we operate. We're not going to talk that kind of nonsense. We're going to say to you that if you decided to be any professional, whether it's a trader, a doctor, a carpenter, anything else, you must start out with the basics. A medical student will start out by understanding how the human body conceptually works. From there, they might begin to understand how to cure particular ailments. If they didn't know that we as humans have a heart or lungs or any other organs, it would be pretty difficult in terms of helping patients. If you as a trader didn't know what drove the price, that would be crazy. So we're going to look at things from our own unique perspective. And what is that perspective? Well, I suppose in terms of our perspective, my own background is from within the hedge fund community, after that from within the brokerage community, in terms of specific market makers. So our perspective is trying to teach you to trade like a market maker. And why we want to teach you how to trade like that is because they make a lot of return. So what better group to learn how to trade like? So it's all about that consistent, conservative, long-term growth. And that CRT, Edwin, I'll be explaining all about that counter retail trading because that is what our course is. I'll be explaining about it throughout the duration of this foundation trading program. So, interaction. I can see there are a lot of people who were asking about the interactivity and asking questions along the lines or in terms of how do we engage? How do we ask questions? Is it possible to receive slides? Let's speak about all of these items. You've got a control panel on your screen. You've got an orange arrow which increases or decreases the size of this area. Within this area, if you've got a question, type it in and we'll certainly answer it. The key point here is that if your question specifically relates to where we are at, we'll answer it then and there, Paolo, Jason and everybody else in spoken form. If not, or if it might interfere with our train of thought or another's, we'll give you a typed answer back. So we've got a dedicated support team, all individuals who know everything which we are covering in detail. They'll be able to help you to answer in real time. They'll be able to help you to remain on track. At the end of every single webinar, we will remain at your disposal to go through all of the remaining questions in real time. Okay? In real time. Now, the biggest question which has come in so far relates to how do we access the recordings? How do you access the lesson after the fact? Or what if you miss a lesson? Or what if you are going on vacation? Anything of that nature. So in terms of the recordings, we give out the recordings as opposed to the PowerPoints typically. In terms of accessing those recordings, let's run through it now nice and quickly so we can all understand that process. So even if you came to us through showacademy.com, regardless as to how you came to us, in order to access the recordings of this course, you've got to go on to www.academyft.com. And up in that top right-hand area, you'll see there is a little sign-in button. Click on that, and you'll then be prompted to enter in your username and your password. So your username would be the email which you used when you originally signed up for the course. The password would have been one which you generated yourself. It is a password of your own choosing. If you've forgotten it, do not worry. There is another option. You'll be able to pop in your username, which again is your email address, and then just click on that forgot your password button at the bottom of that login area, and then make sure that you do check your email, whether it goes into your inbox or your spam or your junk mail folder. You'll get an email almost instantaneously which will remind you as to what your chosen password was. So that option is there for you. When you enter into this members login area, as we call it, you get a nice little welcome to start with. You're also able to start each live webinar at the appointed time whenever it comes across. So you don't have to go digging in your emails every second night or every week or whatever the case may be in order to start the webinar. You can just click on the button within and all will be good. We can see down at the bottom left hand side the introduction video, that 5-minute video which explained a lot about the course. That's already there for you to view. And as we progress, lesson 1 will be available within 24 hours of this class coming to an end. And then on an ongoing basis, within 24 hours of each subsequent class, each lesson will be populated right across the screen and you'll be able to access it for as long as you wish after the fact. So that's quite nice. That's quite useful for people. We also want to make you aware that we will be running a competition throughout this webinar series. We launched it only a few months ago and it's been fantastically successful for us. What we like to do is we like to encourage people to attend these live classes because it's our inherent belief that those who are able to attend these live classes by its very nature will be able to succeed the most. And that is because you'll be able to ask us questions. It's as simple as that. When you're learning in that passive manner, you don't get a chance to ask questions. If there is a point which is confusing to somebody, it remains unanswered, and we don't like that. We like to be able to answer every question which you have. So we will reward those who attend the live classes, and by a reward we'll be giving away free membership, free lifetime membership to the Show Academy. We'll be giving that away at the end of the 8th lesson. There is a little bit of a caveat to that. The draw will be only from those who have attended more than 50% of the lessons live. So that's the little bit of a caveat. That's the encouragement which will hopefully get you guys to attend as many live classes as you can and get the absolute most from this foundation trading program. The last little bit of housekeeping which I want to go through before we get into the thick of this evening's class is to talk about our free course resources. Of course, we're in the online space, so that means we're also very adept with our social media. We have a Facebook page, we have a Twitter page, we have a Google Plus page, and you will have access to any of these items or all of these items if you wish, and we will on these be discussing the topical items which pop up quite frequently. It is, of course, a massively convenient way of communicating. So what we'll do maybe this evening is we'll pop into that chat box. I'll get the support team to pop into the chat box, the Show Academy Facebook page. So I believe it's just facebook.com/Show Academy. And that will allow you to check us out from that social perspective. You'll be able to see all that free resources that we pop up, and hopefully you'll be able to see the additional resources which we'll be able to provide you with free of charge. And we'll maybe put in a new social media link in the first couple of classes, so you'll be able to avail of all of our services. So I think that's about it. That's the background, I guess, to the Academy of Financial Trading. That's the background to Show Academy. And it's most, if not all, of the housekeeping duties out of the way. So let's get into things, Laura. Absolutely, your question is received. Let's go in and start looking at the financial markets and explain what they're all about. So, financial markets and why we're all here, I hope, is to generate a secondary income, maybe in terms of looking for profits in the financial markets. So what we believe our job is I guess quite straightforward. You see, you have traded before. You've traded in some way, shape or form, because what the financial markets are, it's just like any other marketplace. It's just like a fruit market or a local food market. When you go to a local food market, guys, let's try to go through some role-playing scenarios, okay? And let's talk about this and let's figure out all of our perspectives. If you went to a food market and if somebody had, let's say, a bunch of strawberries for sale for $1,000, what would you think? What would you think? You go to a food market, you go in, you've had a hard week in work, and next thing you see that there are strawberries for sale and the price is $1,000. They're not made of gold, they don't make you live forever, they don't cure grey hairs, they don't do anything of that nature. What do we think of that? Well, a lot of people are typing in that it's not a bargain. Georgina, you're saying you'd buy the raspberries instead. Jan, you're saying that it's a nutter. Absolutely. Tony, you're saying it's QE gone mad. There is a shortage, said Edwin. I would go into selling strawberries, said Jack. Absolutely. So we'd probably go with any, if not all, of those suggestions. Very good. So we wouldn't be exactly keen. We'd say that it's way too high. It's much too expensive. We're not interested. But guys, how did you know that? How did you know that? Can we step back for a second? How did you know to think that the price was too high? What made you make that decision? How did you do it? Well, you did it because you know the price of strawberries. You know how much you paid yesterday or last week or last month or any time period in the past. You see, you remember the price that you previously conducted a trade at. And you know what we do as traders? We do the exact same thing. We make comparisons. And then we look at, well, how much does it cost to get those strawberries there? How much should an individual make in that type of situation? We use logic, we use deduction, we use supply and demand. Just like you do every single day when you buy or sell things. Our job is to just show you that connection. So when we talk about these financial markets and when we look at them a little bit further, we can say that all objects are similar because of one constant. And that constant is you and I. We are human. And because of that, our human emotions, they come through when we agree as to price. Because the price on the screen is just a consensus of value. It's a price that a buyer and a seller just agreed upon. So what we do is, we just view these charts, whether they're for Facebook, whether they're for Apple, whether they're for gold or currencies or commodities or market indices. We just view them as representing agreement. And then we try to figure out what direction it's going in. Is it going up? Is it going down? Or is it going sideways? And then we just ask ourselves, how confident are we? So you have traded before. You genuinely have. So what are the purposes of the financial markets, guys? Let's all try to interact. Let's all try to type in the answers into that chat box. What are the purposes of the financial markets? Why do they exist? What are they for? Type in your answers. Let's see who's got the first answer coming in. I can see making money, said Jack. Trade money, says Thomas, I think. For profit, said Ajit. To allow trading of items, says Christopher. What else have we got? Let me have a look. To regulate the markets. Profits. All of these answers are absolutely fantastic. Let's talk about which ones are most relevant and why. So we talk about raising capital to start with. People come to us and they ask whether or not trading the financial markets is morally or ethically correct. To be honest, we say that we don't really wish to give a particular spiritual decree in that sort of line. It's not what we're qualified to do. But what we do say is when it comes to raising capital, there are legitimate purposes behind the financial markets. Let's step back and think about this one, okay? Let's say that you own a pharmaceutical company and it's on the verge of creating a magnificent piece of medicine that, if developed, would better mankind, would reduce the damaging effects of a horrible ailment. But you don't have the money to develop it. So does your idea just go back on the shelf? Does your ability to help one another just disappear? Or should you, or could you go out and seek investment? Could you find people to invest money? And it might go public. And what happens is people raise capital. And then what they do, Hassan, is those people who have invested, well, shouldn't they get a return if it works out well? So that's what happens. That's what stock markets are designed to do, to raise capital, to innovate, Hassan. To allow people who had an entrepreneurial flair to actually continue to operate. And yes, they will generate wealth, but they will also generate employment and further society in the process, Sid. So that's one of the major reasons as to why trading and financial markets exist in the first place. So then we can talk about the transfer of risk. We're going to use this word risk a huge amount, and I can see people typing it in already. We use it because other people avoid it. They're afraid of it. They're afraid that they're going to scare you away. Because they think if they don't talk about Ferraris and Lamborghinis and beaches, that you're just going to go away and not do business with them. We're happy if people like them disappear because we talk about risk. When we talk about risk, we view it as good because that's where we get our return. And when we talk about the transfer of risk, let's do another role-playing situation. Let's imagine this. Let's imagine that we collectively, all of us brilliant people on this webinar, we decide, you know what? Let's imagine that you decide that you don't want to do what you do from 9 to 5 anymore. You want out of the rat race. You decide that you now want to become an agricultural farmer. You decide that you always had this need, Jacob, to go back to the countryside. Okay? So what we do is, collectively, we say, let's go and produce corn. Let's go and produce corn, the agricultural crop. What risks do we face, guys, collectively? What risks could we face, Jacob? What could possibly go wrong for us, the new corn producers? What could go wrong in this magnificent world of ours? What do we think? Absolutely, you've all got it. Let's really challenge ourselves. Let's think about the answer. And let's push ourselves to learn these points. Because typing in the words, and even if you get it wrong, you still learn something. Lots of people are typing in weather, or typing in climate control, or typing in tax increase. Okay, so we're corn producers. We go out and we try to make lots of corn. But the weather comes along and it absolutely destroys our crop. So we're pretty annoyed. So what do? Well, we go to the insurance industry because we want to say that next year we want to ensure that our crop, we're going to ensure that we're going to produce a certain amount and we're willing to pay a premium because the effect, if I get it wrong, could wipe me out. So the insurance industry develops. So we're fine with that. Ladies and gents, is that all that could go wrong for us as corn producers? Or is there something else which could go horribly wrong? Great stuff. A lot of people are getting it now. We could end up with tons of corn. And what if nobody wants it? What if everybody else has tons of corn? We could have literally mountains of corn, but if we can't get a good price for it, then what's the point? Okay? So what we do is we say to ourselves that this is absolutely insane. We want to develop our holding. We want to invest in infrastructure and roads and machinery and employ more people. But we can't do it because we cannot plan our financial affairs. What we must then do is charge the consumer more money to offset our risk. Do we think that's fair? That we charge the consumer more? No, that's not right. That could create hysteria in the market. And then the price of food could go up to a point where we can't even afford it. That's not how things should happen. So what we then do is we say, well, okay, who wants to buy our corn? So we'll sit down with a manufacturer of items which requires corn. So we say to them that we need certainty as to how much they're going to buy the crop from us for. And the producer says, the manufacturer says, you know what? This would help me. Because if we both have certainty, we can both plan our financial affairs and we can lock in the futures price. That's once we agree that we have it of a particular quality and once we stick to our agreement. So what develops is what's called a futures market. Commodity exchanges. And what that helps to achieve over the last 150 or 200 years is stability in terms of the most important thing which we all need, which is food. And that's what happens. And behind the scenes, there is risk being moved around all over the world. And what we can do as speculators is we can buy or sell that risk. We can say that we think the price of corn is going to go up because maybe something crazy is happening in Eastern Europe. Maybe we feel that the weather is so hot or something along those lines. If we have an opinion, we can get involved and take some risk and make some profit. So the transfer of risk is crucially important when it comes to financial trading. Then what we have is price discovery, and that's a nice easy one. Okay? Price discovery means we negotiate. We go to the local market and the guy or lady asks and the guy or lady who is asking for $1,000 for those strawberries, we can politely pick them up and throw them at the shopkeeper one by one. That would be quite an aggressive way to discover the genuine price. Another way might be to ask that individual, what is the real price? Or better put, how much did you sell your batch of strawberries for? The shopkeeper tells you, you then make a counter offer. So we negotiate. Then we have the transfer of liquidity, which is moving money around the world. You want to develop a particular, a manufacturing plant in Europe. If you're coming from the United States, you're going to need some euros to develop it, so you move some money. But you see, those who have traded, or those who have speculated, you mightn't have even considered these points. You might have thought all just about speculators. Did you ever stop to think about international trade? Maybe the price is going to be reached for that particular item, then people just won't buy it. Maybe they're going to buy something else. Maybe they're going to say, no way, there are other alternatives. So that's what you've got, international trade. And for that, it makes up a massive amount of every single market. So these areas are certainly to help us have a holistic overview. And don't worry guys, at certain points you might miss a particular point. When I went to university it happened all the time. That's why you study after the fact, to make sure that you grasp it. That's why we make the recordings available to you. So let's look at accessing the financial markets. Online trading allows you to speculate on the future price movement. You can trade 24 hours a day from Sunday evening to Friday evening. You can trade it from anywhere once you have an internet connection. There is a comparison. Just because you can do something doesn't mean you should do something. Okay? Just because you can do something doesn't make it any easier. And what we're on is, I guess, a bit of a crusade. And what that crusade is to show you that you must learn before you go rushing into trading. You must have an understanding, because otherwise you're competing against people who do have an understanding. There are things which you need to understand, and they are essentially what is tradable, who else is trading, and when and how to trade. Now this evening, we're going to look at the top two headings. The third heading is not an easy one to cover, but we're going to cover it throughout the rest of the course, and hopefully we're going to have lots of fun along the way. So when we talk about what is tradable, let's have a look. Let's speak about this a little bit. And don't worry, you don't need to make notes. As I said, you can go through on the recordings as well. So we speak to begin with about options contracts. Who here has traded options contracts before? Type in that word options if you've traded options contracts previously. Let me have a look. Who has? I can see Zach and Daniel and Mark and Sid and James hasn't, excuse me. It's not massively popular outside of the US. It's very, very popular inside of the US. So, what are they? Well, they give you an option to purchase something at a particular price at a particular time. They give you a right without an obligation. Now, guys, let's just do something to really nail home our feelings on this subject matter. Do you think the price of gold will go up or go down in 6 months' time? Just type in up or down. Do you think the price of gold will be up or down in 6 months' time? And when we ask these questions, it's really fascinating with the answers which are coming in. Let me have a look. Let's see what the consensus is. Do you think the price of gold will be up or down in 6 months' time? Generally speaking, we've got up coming in. I'm going to take a guess as to why that is in terms of what's happening from an economic stance across the world at the moment. A lot of people typing in were up. That's okay. Now, guys, give me some help on this next question if you don't mind. Could you tell me the price that gold is going to be on, let's say, the 7th day of September this year? The 7th of September 2016. Just the exact price if you don't mind. Just type in the price that is going to be on that specific date. Okay, so do you appreciate how ridiculous that question was? Do you appreciate that I probably was foolish for asking that question? Or was I? Because can you appreciate that the first scenario was a hell of a lot easier than the second scenario? Calling the direction isn't easy, but calling the exact price in time is massively difficult. That's why we don't like options contracts, because they're too tough. Okay? Next type of contract. Futures contracts. This we like. You can speculate on upwards or downwards movements. You've got flexibility in terms of when you enter, when you exit. The only issue here is that there is some leverage, but not a huge amount. Now, leverage will be covered completely in 2 days' time, but what it relates to is the ability to trade larger amounts. And trust us when we say that it will be covered in 2 days' time. So we kind of like futures. We look at spread betting. Okay? And in particular jurisdictions, it's hugely popular. In terms of spread betting, we have some issues with it. The gains are tax-free, or the gains tend to be tax-free, okay, in certain jurisdictions. So let's ask another question along that lines. Let's ask another question on those lines, Connor. Have you ever encountered the revenue officials in your country to not to tax an area where people were making lots of money? Have you ever encountered an area where you just thought that the revenue officials are totally asleep? There are lots of people making lots of money, and the revenue have just decided, you know what, we're just going to have a sandwich today. We're going to sit at home, eat lots of sandwiches, and not tax the people. What do we think? Do we think that's plausible? What do we think? Or do you think that they're not taxing the people who make money because if you tax on profits, you must also offset losses? So if the people are going to be taxed in profit, every single person who loses could claw back those losses from a capital gains tax perspective from the revenue officials. The revenue officials in most jurisdictions are not foolish. There are strong reasons as to why gambling and betting in many jurisdictions are tax-free. It would kill the exchequer to tax it. This type of speculating, it sees you betting on the financial markets. Anybody who thinks otherwise clearly has a problem with that word betting. Okay? You're betting on the markets. What's happening is that somebody else is taking the other side of the trade. They're speculating that you are going to get it wrong. They'll tell you that we're lying, but we're not. Their interests are at odds with yours. They need to see you fail in order for them to actually make money. So the next type we want to look at are CFDs, contracts for difference. And Kevin, just before we progress, maybe you're asking why would there be a conflict? Kevin, it's no other than any conflict in any bookmakers in any jurisdiction. Any bookmaker, the only way they can make their money is by their clients losing. And a spread betting broker is no different. The only way the broker can gain is for you to lose your money. So that's the conflict. You want to make money, the broker wants you to lose money. So the next one is CFDs, contracts for difference. This is another way of trading. It's not really allowed in the States, contracts for difference, because of the rate of leverage. Leverage, again, will be explained completely in 2 days' time. But contracts for difference, we tend to like. It also falls under the remit to a degree of forex trading. So if you are based in the US and you think that you're not able to trade during these methods, don't worry, you will be able to, because a lot of these CFDs base brokers, they also allow you to trade forex markets and commodity markets, which is where you will be able to work within. What you want to look for are STP brokers, straight through processors. Because these guys, their interests and your interests, they can be aligned. So they allow you to speculate on upwards or downwards movements. As well as that, typically speaking, with the right operators, you can trade as little as 10 cents or 10 pence per pip or per tick. So you can speculate on very small amounts of capital so you can learn in a very efficient way. So STP stands for straight through processor, straight through processor. And if I'm going through terms that we haven't covered yet, guys, don't worry too much about it. That's what this course is about, to go through every term in detail. We're only 40 minutes or so into the first class. We have a long way to go yet. In 2 days' time, again, we're going to cover that leverage side of things, the PIP side of things, and everything else along those lines. Leverage can allow you to trade with larger amounts. It can increase your gains, but it can also increase your losses if you are not careful with it. So, we're going to have a look at some frequently used terms when it comes to trading. So, one way to enter the market is by going long. And by going long, it means that you are buying the market. You're hoping that the market will rise. The opposite side of the trade is obviously to short the market. And if you're shorting the market, it means that you're speculating that the price will fall. You are selling. You've got bulls and you've got bears. Bulls are considered to be optimistic. They believe that the market is going to rise. Bears are said to be pessimistic. They believe that the market is going to fall. And where these terms come from is the way each individual animal attacks. For anybody who's ever watched any bullfighting, or for anybody who's ever seen a bull in action, you'll know that a bull attacks from below to above. They put their head down towards the ground and then they drive themselves upwards. So they drive the markets upwards. Whereas a bear does the exact opposite. If a bear is attacking, they tend to stand up on their hind legs. Thankfully, I don't have any personal knowledge of this, but it's said that they stand up on their hind legs and they push the market down. So that's where those two terms come from. They've been around for almost as long as the markets have actually existed. So a person can be said to be bullish if they believe that the market is going to rise. A person can be said to be bearish if they believe that the market is going to fall. You don't have to be one or the other. You can be both. You can change your mind when the time is right. That's the key to it. Okay? You don't have to be bullish all the time. You don't have to be bearish all the time. You can be one or the other. You can be one today and something else tomorrow. So we need to have a look at what moves prices. So what do we think moves the prices in the financial markets? What do we think are the main driving forces behind the movement of prices? This one, it tends to always catch some people out. What do you think moves the prices in the financial markets? Let's all try to type in the answer. Let me have a look. What are the main components? What are we watching out for in all of these scenarios? Okay, we have a huge amount of people who are typing in news items. News items move the financial markets. We have people typing in speculation, political affairs, conflicts, and all of these other things. But you know what? There's only two things which moves the price in the financial markets. Nothing more and nothing less. And that is supply and demand. And what happens there is every single thing else is a subset of supply and demand. Greed, you want more of it. Lack of greed, you want less of it. War, you want more of something. Okay? Economic fallout, you don't have the money for something. Everything boils back to supply and demand. And yes, John will give out those virtual high fives if we can. Where supply and demand meet, it's called an equilibrium. And this is only ever achieved in theory. Because as soon as supply and demand meet, what happens then is something changes. The world changes. And from there, we have to have new areas in the market. We say to ourselves that in times of scarcity, prices typically rise, Rory. Absolutely. As does over-demand push prices up. We will say that there is too much of something, the price goes down, or when there's too little demand, the price will fall. But you see, even though supply and demand is the major aspect of the financial markets, would it surprise you if we told you that that's not how we make our profits? We're traders at the Academy of Financial Trading. I personally have traded myself for, I'd say, 10 years or so, maybe even more than 10 years at this stage, and profitably so. And we don't use supply and demand. So why don't we use it? We don't use it because it would drive us crazy. We don't use it because it's too tough. Now, we're not the type of people who move away from things just because they're tough, but we're the type of people who say that it's so tough, it's impossible. Because there are too many variables which affect supply and demand. And I know that there are people sitting there who will say that this is nonsense, that this is wrong. It's not wrong, and let's show you exactly how. And Connor, oil, absolutely, it does use supply and demand. But let's look at it like this. Oh, that oil example is a great example. Let's look at it from that fundamental perspective. So you and I, let's imagine we trade crude oil. Can everybody type into the second decimal place how many milliliters of crude oil you will use? Let's imagine this coming Friday of this week. What is it? The 5th of February, this coming Friday. And let's include in there all motor vehicles, all transportation, all heating, all plastic bottles that you consume which took crude oil to make. Just type it in, guys, if you don't mind. It's only a few days away. Type into the nearest milliliter. And this is pretty surprising. Everybody's typing in that they couldn't really do it. Some people are typing in 45 barrels. Other people are typing in 1,000. Other people are typing in 40 litres for of us. Okay, what else? 37,000, says Hank. Massive users of oil. Okay, but let's take it a little bit seriously. You as the consumer, you don't know how much you're going to demand. How on earth could I, sitting here, have any idea how much you want? I do not have a large crystal ball. I do not have a cape. I do not go through any sort of strange rituals. I cannot know the answer. So why don't we just give up trying? And why don't we just say, how much did you consume today? How much did you consume yesterday? How much did you consume over the last 10 days? Let's average it out and have an informed opinion. So that's what we do. We don't try to predict the future. We just ask ourselves what has happened and we make a decision. Now, there are people out there who will look at balance sheets of companies. They will be happy to invest based upon information which is 1 year or 2 years old. They will forget that a bank like Bear Stearns, from an economic perspective, when analysed just before the crash in 2008, it was absolutely fine. People were investing within it. So I hope that helps a little bit. And I hope that it makes sense in terms of our perspective. We measure the market. We invest in entities that we are interested in. We protect our profits and we work with the market. It reduces subjective biases. That means that it reduces our reliance on our own opinion. Now, we're not saying that there are not economists out there who are not good at what they do. We're just saying that it would be impossible for us to teach you those methods. Firstly, because we believe in online education. We believe in teaching people from all over the world without you needing to come into park and to stay here for a day while we speak about the subject. So we don't feel that it would be possible, but more importantly, it's not how we profit. So we like the idea of accepting that the price reflects everything got to do with supply and demand. We apply techniques to find opportunities. We reduce the random nature of decision making. So we hope that has put into context many of the future lessons of what our approach will be. Now, this evening, I'm already watching the clock. We're 10 to the hour, and I can appreciate that we're probably going to run over time ever so slightly. I do apologize in advance. We'll probably be maybe between 5 and 10 minutes past the hour before we start into the questions and answers. So, I suppose on these live webinars, sometimes it can be difficult to stick to the exact times. Apologies, guys. Let's keep going. What we want to do now is I'm going to give a reasonably quick run through the main asset classes which we will be looking at throughout this foundation trading program. If you feel I'm going to go a little bit too quickly through them, don't worry too much, because I will be recapping across it at the start of the next webinar, okay? So Sean, these webinars, they tend to run for an hour. This evening is going to be going on for maybe an hour and 5, possibly into an hour and 10 minutes, but hopefully no more than that. Well, definitely no more than an hour and 10 minutes, okay? So currencies are hugely popular for financial traders. And if we're a bit silly, you'd say that it was because currency-based brokers have massive budgets. That's probably one of the reasons why, and they can afford to make very nice ad campaigns. But outside of that, what forex trading and currency trading, why it appeals, is because you can use currencies as a safe haven. And imagine you were concerned about the region in which you reside. You could put your money into, or your assets into, a different currency. You might look for a return on investment. You look at euro, where the interest rates are way down, just like the States, even though the States put them up ever so slightly, about 2 months ago now. People are getting negligible returns, so they're putting their money into other regions. You might also feel that one currency is stronger than another. What we do is we trade what we see. We don't actually know what's going to happen next. We measure the movement, we look for the opportunity, and we trade accordingly. We say that the why is the causal factor. It's the historical reason why something happened. But the what, the very effect itself, is what's fundamentally crucial. We trade what we see, and we leave other people to ask why. This is absolutely crucial, because as we mentioned earlier, our own backgrounds within especially the brokerage community, it was really fascinating because it shaped our outlook on the financial markets. Because all day long you would have clients calling you up asking, why did euro dollar just fall? And you're the broker, you're supposed to have an answer to this. But there is no answer, it just fell. It fell because people didn't want to buy it. It fell because people sold at lower prices. That's what happened. But what other people will do, what other brokers would do, is they would go out and they'd Google and they'd ask why the euro dollar is falling. And the internet has an amazing ability to answer every single question. And then those brokers, they would pick up the phone to their client and they would say, yeah, it fell because you see this piece of information here. The client would probably then feel comfortable as to why something happened. Then they would take an opinion in the marketplace. So you look at it and it's just madness just to try to explain something after the fact. Why not just accept that there is weakness in the market, it's falling, and look for the opportunity? So that's what we do. So what we're looking at are charts like this. This is a euro dollar chart. This is a current euro dollar chart. We can see it's euro dollar because it says so up that top right hand side. It also says that it's a daily euro chart, which means that each and every green or red candlestick, which we'll be going into a lot more in the next class, is worth 1 day of trading. The euro element is running along the bottom of the screen. The euro remains constant. The dollar element is on the right hand side of the screen, and that varies up and down. At the moment, we can see that 1 euro is worth $1, 1.08869 cents. And it goes up and down as the case may be, as people buy or people sell. And this is trading. This is what we like. This is why we are here. And this is what we're going to be focusing on throughout this foundation trading program, this kind of trading. Currencies, they are popular. They're popular, which means that they are liquid, which means that you can get in and out of them very, very quickly. There is very rarely a gap in a currency market. Okay? If anybody ever traded in an illiquid market, in a market which was not as popular, you would know all about it. A market which would not be as popular would be something like the penny stocks, I guess, which would be used to over on this side of the world, particularly in the UK. In penny stocks, there is a lot of gaps. There are a lot of movements. There is a lot of areas where the prices never reach. We like currencies because they are popular. You can get in and you can get out whenever you wish. And as well as that, the information about each market is very, very freely available. You don't have to look too far in order to find out anything about the market which you have an interest in. And transactionally, in order to trade these markets, the costs are very, very low in normal. Rory, I like what you're saying about penny stocks, absolutely. So that's one asset class. The next one we want to look at are commodities, are energies. And when we speak about energies, you look at things like crude oil and natural gas. And for a variety of reasons, these items fluctuate and are very, very volatile. They move quite a lot. Because for reasons, I guess, outside of the scope of this webinar, unfortunately, these items are often produced in regions of political or social instability, and that impacts our ability to acquire these items. And then we see massive fluctuations. We also see global economic outlook. So we have a list of all of these items, and it is important to be able to access this full range of markets. We can then have another look at the precious metals end of commodities. Precious metals are typically seen as a safe haven. They're somewhere where they go to when they get scared. So do you think when you're scared that you behave rationally, guys? Do you think that when you're scared you behave rationally? What do you think? Generally speaking, when one is in fear, one is irrational. I think that's fair to say, normally speaking. So one can be totally irrational. And if you've got a market which is purely related to human emotion, do you think that market will be volatile or do you think it will be calm? If it's fundamentally related to how humans feel about the world, what do you think? Absolutely, it's extremely volatile. It results in opportunities. It fluctuates quite quickly. So we actually like that. We like anything which moves, because anything which moves can generate a profit when managed correctly. Let's look at soft commodities. Soft commodities are items which are grown as opposed to mined. And these offer fantastic opportunities because, as we saw earlier, you can have weather-related matters, you can have pest infestations, you can have global demand, you can have safety concerns. So we love finding opportunities in these markets. So the soft commodity sector is another asset class which we'll be looking at throughout this foundation trading program. Next up, we're going to have a look at the stocks and market indices. These allow us to access financial markets. And during this course, we're going to be covering this diverse range of markets. We're going to be looking at all of the markets which we have been discussing up to now and beyond. So equities are designed to raise operating capital. We speak when talking about the equity markets, we speak about speculators. Speculators come in to make this market viable. We also have market indices. What we mean by a market index is a situation where you can trade a basket of objects. You could trade, for example, the S&P 500, which is an index, the plural being indices. So the S&P 500 is the top 500 listed companies in the USA. So that's a nice way to access a market if you couldn't otherwise access it. Because if the top 500 markets are not performing, well then it gives you a good insight. Our top 500 objects, top 500 companies aren't performing. Well, it means that there are issues in terms of the economic health of that particular region. Now let's have a look at the bond market. And these have become hugely topical over the years for obvious reasons. And let's have a quick look as to these bond markets and how they work. They're basically IOUs. Okay, every government, they need capital in order to maintain its day-to-day business, to pay the likes of civil servants, to make sure that the utilities which we all know and love and we have to, or we couldn't survive without, that they're able to supply us with them, I guess, for want of a better word. So they need money up front. Okay, and what happens is that they will raise this money, they will raise this capital by offering a bond to the market. And the offering will be based upon a percentage return which that government will give in a certain number of years. You could have a 6-month bond, you could have a 1-year bond. So, Connor, bonds are offered by governments essentially. Okay, so let's say even here where we are in Ireland, we offer 1-year bonds or 3-year bonds or 5-year bonds or 10-year bonds or 30-year bonds or whatever the case may be. And those bonds are offered out in order to entice people to give money to the government so that it can conduct its day-to-day business. And in order to try to entice people, the government will offer a certain return. I like the little snippet there, Gavin. James Bond's not really, but close. Okay, so if the interest rate which the government provides the people with is at an attractive level, then that bond will be successful. People will buy into the bond, so the amount of money required will be raised, and it will be seen as a successful offering. You can see it maybe how this interest rates affect the markets and what governments need to do in order to make these offerings attractive by using the comparison of maybe the likes of Greece and Germany. Greece would be seen, unfortunately, at this stage as quite an unattractive investment because there is a lot of uncertainty about its future. It would have a reasonably high level of unemployment. There would be uncertainty about the market in general. But so in order for the Greek government to make their bond offerings attractive, they would have to supply the public with quite a high level of interest to try to make it sound worthwhile. So they might have to offer an interest rate of 10% or 12% or 15% or 20% in order for anybody to provide them with this funding via the bond market. So that's a very, very high rate of interest. But then you've got the opposite side of the scale. You've got a government, you've got a country like Germany. And Germany would be seen as quite a stable environment. It would be seen as a place where there was a lot of confidence, where there was low unemployment. It's the manufacturing engine of Europe. So Germany would have a lot of natural attraction to people who want to invest in bonds. And because of that natural demand, it means that Germany does not have to pay as high a rate of interest. Indeed, Germany can sometimes get away with paying a negative rate of interest, where you don't even get back the same amount which you give in. But that's still seen as a safe haven. Because people are happy to give money and receive a little bit less back after 1 year or 5 years or 10 years because they feel it's safer there than somewhere else where they might risk a lot more. And we can obviously trade these bond markets by using contracts for difference and other such tools which we will be speaking about. That's what CFDs stand for, contracts for difference. And they're the tools and similar which we'll be using as we progress. So that's that side of things. And now with all of these different markets, you've got so many choices, we've got to ask, what should you look at? We know that there are people out there who will tell you to trade one market. We know there are people out there who will allow you to trade for free. Okay? Because obviously they're a charitable organization and they just want that warm and fuzzy feeling. So what we prefer is to say that if you spread your risk around, you are less likely to encounter major headwinds. So that's what we try to do. We try to reduce the swing in our account from day to day. And we must also talk about who makes up the markets. Large financial institutions, they manage their risk very well. That's the lesson we'll take from them. Multinationals, they focus on hedging. We'll cover that much further. Then we've got speculators. We've got you and I. And what we do is we take risk in return for reward. We take risk in return for pursuing that larger upswing. And all of these three categories, they fundamentally interact. And we ask ourselves, how do most people trade? Well, they trade looking at fundamentals, they trade looking at technicals, but most importantly, they tend to trade badly. What we are going to help you do is to not trade badly. We're going to look at counter retail trading techniques. We're going to look at how a market maker goes about their business. And this is important. Now we're finally coming towards the end of this evening's lesson. But before we go, I'm going to ask you to make a decision. And we're going to ask you to make a decision at the end of most of these classes. Okay? Because in trading, we must make decisions. It's as simple as that. If we're unable to make a decision in trading, we'll never be able to even enter the market, let alone exit the market. So what we're going to do this evening, even with our combined limited knowledge, is we're going to have a look at a chart and we're going to make a decision. We're going to decide if it's going to go up or if it's going to go down. We're going to decide if we would buy the market or if we would sell the market. We're going to decide whether we would go long or we would go short. So this evening we're going to look at oil. And we saw this chart a little earlier on. We can see the price is trading at about $32.83 per barrel. So what I'd like you to do is type in whether you would go long, whether you would go short, or would you do something else. So this oil market, it is just from the 4th of October of last year right up to date, right up till early February 2016. So what would you do? Would you go long? Would you go short? Or would you do something else? Okay, and while you're typing in your answers, I'm just going to provide you with a little bit of a clue maybe. The type of things which we will be looking at as we progress through this foundation trading program. The types of patterns which we are looking at as we progress through this foundation trading program. Why was this area so significant where the price went down and bounced away from it so often? And why, when it did actually break that area, was there quite a reasonable move down? It went down from that 41 level all the way down to the high 20s. Could we have spotted that beforehand? If we could have spotted that beforehand, could we have taken advantage of it? And since then, since the middle of last month or so, it's gone up from that $27, $28 area. We can see the price is increasing ever so slightly again, and we can see it's moving upwards. So this is what we're going to be looking at. We're going to be trying to figure out where the market is going to go, what levels are of interest to us, and what we should do at those levels. So, I want to give a warm congratulations to every single person on this webinar this evening because you've just completed the very first class of your foundation trading program. A massively good achievement. We're going to do our very, very best to make this full course hugely enjoyable. There will be things which you don't grasp. There will be questions which you will have. But trust me when I tell you that the team here at the Academy of Financial Trading, it's going to help you. Every single person is absolutely amazing. We're very selective as to who we allow into us. So the coming lessons are going to be very, very important. Attend all of these lessons if at all you can and ask as many questions as you can throughout. The next step for you guys, you've got a lesson in 2 days' time. If you attend greater than 50% of these classes live, you'll be in with a chance to win a prize for a lifetime membership to the Show Academy, to the Show Educational Group. Okay? You'll be able to access the recording of tonight's class in your members login area in about maybe 17, 18, 19 hours. There or thereabouts. So that's what we have for you this evening. If there is anything outstanding at this stage, what I'll do is I'll take about a 30-second break. I'll have a quick drink of water, type in any outstanding questions into your chat box, and I'll be back in about 30 seconds or so, and I'll go through as many of them as I possibly can. So give me about 30 seconds, goes, and I'll be right back. Many, many thanks. Okay, guys, let me have a look. I'm just doing a bit of scrolling here so I can get to the top of the questions if I can. Tanisha, you're asking what is market indices? It's just the plural of a market index. Tanisha, the plural of a market index. A market index is like the Dow Jones 100. It's like the FTSE 100. It's like the DAX in Germany, or the CAC in France, or the ASX in Australia. So it's just a grouping of companies which are able to trade them as a collective within an index, the plural being market indices. Of course, the recordings are available. They're available within your members login area. Go to www.academyft.com. Go to the top right hand side of the page. There's a little sign in button. Click on that button. It prompts you to enter in your username and your password. Your username is the email address you would have used to access even this evening's webinar. The password you would have chosen yourself. If you can't remember the password which you did choose yourself, click on the lost password button and we'll email you instantaneously with a reminder. It will go out instantaneously. If you can't see it in your inbox, check your spam mail, check your junk mail folder. It will be there. The recording of this evening's class, it will be available from about 15-16 hours, maybe a little bit more, no more than 24 hours for certain. But about 15-16 hours normally is when it is available to you. What else have we got? There's people talking about CFDs, talking about a little bit of confusion. People talking about spread betting, talking about a little bit of confusion. Options, talking about a little bit of confusion. Don't worry if there is any confusion, guys. We're in the very, very start, the opening stages of a 10-part program. We're only one class in. I would be surprised myself if I was able to get to a point where I was able to explain every single thing this evening. It just wouldn't happen. This evening is more of an introduction, I guess, isn't it? We're just kind of setting the tone for what's going to come for the remainder of this foundation trading program. In the next class in 2 days' time, it is dealing specifically with the explanations, I guess, of specific trading terms and phraseology and jargon and all that kind of stuff. So we'll be getting into a lot more detail about spread betting, about leverage, about CFDs, about options, and going long, going short. We'll be talking about pips. We'll be talking about stop losses. We'll be talking about a huge amount of detail and giving full practical explanations for everything which we do. So hopefully that's okay. What else have we got? Price action, Owen. It's literally, what is the price doing now? Is it going up or is it going down? Donica, you're asking, if you go short, will you lose money? It depends on whether the market will go short as well, Donica, but it's absolutely possible to short the market, to sell the market, and to make money in it. And we'll be going through that as well in the next class in 2 days' time. Anna Luisa, you're asking, is leverage plus debt, or is leverage equal to debt? Not at all, Anna. It's not. It's just a multiplier, and I'll be giving you, I guess, a more practical example in 2 days' time. What else have we got? Shadi, you're asking if there's a chance to lose money when investing in bonds. Look, it's very important maybe to point this out. It's possible to lose money no matter what the market you're looking at. If you've got the wrong side of the trade, it's possible to lose money in each and every instance. What we'll be trying to do over the course of this webinar series is to try to help you understand the markets in a huge amount more detail in order to help mitigate any risk, to help lessen any risk. But there's always going to be inherent risk. That's massively important. Jacob, you're asking what was the answer to the crude oil. I didn't give an answer, Jacob. I didn't give an answer specifically because I want you to tell me and not the other way around. As we progress then throughout this webinar series, you will begin to understand more and more as to the things you should look for, and you'll be able to come back to me with a more informed decision as to what you feel the market is going to do. There's absolutely no point in me telling you this evening what I thought it was going to do, because I would then have to give explanations as to why and which and what, and go through a huge amount of detail which we have yet to cover. What else have we got? To go long is to buy, to go short is to sell. What else have we got? Let me have a look. Tiago, you're asking what happens if the government doesn't pay a bond. Well, then the chances of that government ever being able to raise money at any point in the future would be severely limited. If a government was to, let's say, we've heard of it before, it's called burning the bondholders. If they were to not pay the bondholder, then the government's ability to raise money at any time in the future would be severely compromised. What else have we got? Let me have a look. Terence, you're asking what is a great trading platform for traders? Great question, Terence. And luckily, as part of this foundation trading program, we'll be showing you exactly how to access a great platform on which you can use to practice trade with absolutely no risk to you a little bit later on, specifically during lesson number 7. What else have we got? Marcus, you're asking which country has burned bondholders in recent times? That's a great question. Did Costa Rica, did Puerto Rico do it quite recently? Somebody else is typing in Greece. Yeah, I think it was Puerto Rico who did it most recently. They missed a bond payment only about a month ago or so, I think, was it? Was it just in January where they missed it? So that was probably the most recent example. Let me have a look. Let me just do a bit of scrolling here. What have we got? Malcolm, you're saying thank you. My question is government bond, way to go. Not necessarily, Malcolm. People like specific markets for whatever reason. Government bonds, they're not bad. Absolutely. I like commodities. I also like foreign exchange. They're two nice markets, I think, for whatever reason. I think I like them because they're massively popular and you tend to go along on the wave of things which are popular. You kind of feel like you're doing something right. Doesn't mean that I'm right. Absolutely not. But it's whatever you have an interest in, really, I guess, to be honest with you. What else have we got? Look, regardless of what we're talking about, guys, regardless of a market, whether it is Forex or commodities or CFD related or options or whatever the case may be, it's all based on speculation, isn't it? So when anybody's asking how a particular market works, that's how it works. It's based upon speculation. It's based upon people's belief that the market is going to go up. If they feel it's going to go up, then they will buy it. It's as simple as that. If they feel it's going to go down, then they'll sell it. So it's all about speculation. So regardless of the market, whether it's bonds, whether it's CFDs, whether it's Forex, whether it's commodities, no matter what it is, it's all based on speculation. What else have we got? Kevin, you're asked what is price to earning ratios. Kevin will be going through that during lesson number 3. What else? Craig, you're asking would I advise to go on a practice account? Absolutely, Craig. That's why we provide you with that as part and parcel of this foundation trading program. What else? David, you're asking, do I think that you could make a living in trading with the proper preparation? Absolutely, I do, David. But I suppose we'd always tell people to not think that they're going to be able to do it tomorrow. It's no different than somebody saying to me today that they want to maybe, play live in Glastonbury at some stage. Okay, so imagine they said I'm going to go out and I'm going to buy a guitar tomorrow and my goal is to go take the main stage in Glastonbury. That's no different than saying that I want to give up my job and I want to start trading for myself and make a fortune. Okay, you're not going to do it today, you're not going to do it tomorrow, you're not going to do it next week, you're not going to do it next month. It takes time, it takes patience, it takes practice, it takes a shot of realism as to what is concerned if that is what you wanted to do. But with the time, with the practice, with the patience, with the dedication, then absolutely anybody could do it. No problem whatsoever. What else have we got? Mark, you're asking about our attitude to risk. I haven't mentioned attitude to risk. both ability to withstand risk as well as psychological ability. Mark, we have a full and complete class coming up it's a while away yet, to be fair. It's lesson number 9. It's the second to last class where we deal entirely with risk. But you know what? We love talking about risk because we feel that none of our supposed competitors do talk about risk. And we know that the only way we can profit in any market is to take on risk. Okay, so we absolutely appreciate risk, we absolutely respect risk 100%, and we absolutely feel that it is probably the most important thing which you need to know before you ever talk about entering the market. Let me have a look. Let me see. I'm just trying to do a bit of scrolling here, guys. Excuse me. Let me have a look. How closely should we follow the politics of a country if you want to invest in their bond market? Yeah, you'd want to have a reasonable idea, Jackie, but the bond market itself, that'll move way quicker than any research can ever be done. So just by looking at where their bond market is at the moment and the kind of return which they're offering people who buy into the bond market, that's a great indication as to what the relative appetite for that bond market is. If the interest rate which is being returned is on the very, very, very low side, then it's perceived to be a very safe haven. If the interest rate is on the very, very, very high side, it's perceived to be quite a risky nation. So that's what we have to weigh up in each and every instance, okay? What else have we got? Let me have a look. I give an example of Germany with a negative return, so I was wondering what's the point of doing that when you can keep the money in bank earning no interest on your money? That's a great question, Pinnakin. Okay, so the example that I used about Germany and their ability to give a negative interest yield is because a lot of people think that there could be at more risk in the stock market. So imagine you put all your money into the stock market and the stock market fell by 50%. Imagine if you then lost 50% of your money. You might lose more than 50% of your money. They would see that that was a lot riskier than going into a bond market and getting back just a little bit less of their money. They would see it as being that safe haven. Okay? So that's what it is. Ben, you're asking if our company, Academy of Financial Trading, is the same as a different company. No, not at all, Ben. I guess your very question would kind of answer that. Is one company the same as another company? Absolutely not. They're two completely distinct companies. What else have we got? What have we got? CPDRs, excuse me, Laura, you're asking about CPDRs. I think for any online course, regardless of length, I think the most amount of CPDRs that can be accredited to you is 3 hours. I think it's 3 hours, but I'll have to double check. What else have we got? Let me have a look. I think that's a lot of it, guys. David, you're asking, will we be looking at options trading? Of course we'll be looking at options. No problem whatsoever. Stephen, you're asking, didn't Japan just implement negative interest rates? Aren't they doing exactly that? Well, that's kind of different, Stephen, to be honest with you. It's the same kind of idea, but a little bit different. They implemented negative interest rates to try to get people to spend their money. Okay, to try to get people to spend their money. If your bank, imagine you're a high street bank, so that's what the Japan is after doing. They're after basically instructing all the high street banks to offer a negative interest rate. All right, so what does that encourage people to do? If your bank is offering a very high interest rate, it encourages savings. Okay, it encourages you to start saving your money because the interest rate is very positive. That if you give them X amount, you're going to come out with Y amount, which is a bit more, in a few weeks or months or years' time. But if it goes negative and you know you're going to get less back, it means you're going to spend a bit more. You're not going to save as much. So that's what Japan is trying to do. It's trying to get its citizens to spend. The best way to get its citizens to spend is to go a negative interest rate. Okay, let me have a look. Tony A, I get that joke. Okay, very good. Amir, you're asking, is this course concentrated mostly on technical analysis? I'd say that's a fair description, Amir. That's a fair description. We do concentrate on technical analysis because we feel that's the best, if not the only way to look at the markets and to be able to profit from them in a trading sense, from a very technical perspective. John, you're asking, won't people simply withdraw their savings? Of course they will, John, and then they'll spend it. That's the point. They will withdraw their savings and they'll spend it. But what they'll also do is they'll be able to afford, let's say, a cheap car, because the interest rate on the car loan is going to be very, very low. They're also going to be able to afford, if you like, a cheaper house, because the interest rate on a mortgage is very, very, very low. Okay, so there's things like that to encourage people to spend. Go and get their loans, take their savings out, spend it on XYZ. So that's the purpose behind it. What have we got? Let me have a look. No trouble, Ben. Many thanks. Let me have a look. Douglas, you're asking if the decision at the end of the chart was correct, Douglas. If you don't mind, I did already say to a few people that we don't give out the answer. There's no point in me telling you what I would do. I would like you to make a decision and to let me know what you think. And then over the course of the upcoming webinars, we will be able to build out your knowledge so that in maybe 2 or 3 or 4 or 5 classes time, you'll be able to make a more informed decision as to what a market might be doing. Okay? Dermot, you're asking if you need to take notes. I know I'd never really suggest taking notes in the live sense. I think if you try to take notes and participate, I think it's quite difficult. I think you tend to lose track. So I just listen and type in questions as we go. The recordings are there for you to go through. If you want to take notes during the recordings, that's absolutely fine, obviously. You can review the recordings as often as you wish. Let me have a look. Stephen, you're asking about what the key factors are when entering any market, is specifically stock markets. We always look at markets just from a technical perspective. Every single time, Stephen, regardless as to what that market is. And absolutely, Douglas, the Q&A is recorded as well. It sure is. Live charts. Yes, David, we'll be looking at live charts throughout, but in particular, I suppose, we'll be showing you how to access these live charts during lesson number 7. What else have we got? Yeah, we'll be going through every single intricate part of trading as we progress, guys. So don't worry too much about it. As I've said already, we can't go through every single thing this evening. We would be here all night and all day if we actually did. What have we got? No homework at all, Kyle, not at all. I'm just glad to have you in attendance. I wouldn't frighten you with homework. We're all good. What have we got? Yeah, Dean will be going through technical patterns like head and shoulders. Absolutely. We'll be also looking at moving averages and different types of oscillators and different ways of analyzing the markets. No trouble whatsoever. What have we got? Athena, you're asking the key factors in oil price market. What are they? It's all down to supply and demand, Athena. It's all down to supply and demand. Okay, guys, I think that's about it. We're coming up to the hour-and-a-half mark. We try to keep things a little bit tight, I guess, because even if you are accessing the accessing the recordings, we think that after about an hour and a half, you tend to lose the will to live. We will, of course, be answering your questions. Anything that does remain outstanding. If I have, or if you feel I've ignored a question, I hope that you don't think it's on purpose. What I've done is I've picked out the questions to try to ensure that the correct answers are given this evening. And for anything that is outstanding, we will be covering it throughout the entirety of this webinar series. So I absolutely look forward to each and every single one of you returning for lesson 2 in 2 days' time. Our support team, they will be in touch throughout this webinar series as well, not only to make sure that all of your questions are being answered, not only to ensure that you are getting from this foundation trading program exactly exactly what you wished, but also to get feedback from you, to see where we need to improve, to see what we need to change, to see what we need to tweak in order to get better every single time. So guys, massive thanks for your participation, your interaction this evening, which is what makes this so enjoyable for me, I must say. But your interaction has been absolutely fantastic. And I look forward to speaking to you all again in 2 days' time. So until then, take care for now. All the best. Bye-bye.